Normally, when you look at a dashboard, whether that's, the dashboard in your car or like the diagnostic dashboard of the global economy, you expect a certain level of, well, basic logic.
Right, yeah. Green means go, red means stop.
Exactly. You expect the systems to actually be talking to each other. But looking at the source material we're diving into today, which is dated June 29, 2026, it feels like staring at a car dashboard where the engine temperature gauge is just buried in the red.
Yeah, just flashing these catastrophic warning signs.
Right. But then the speedometer says we're somehow accelerating smoothly down the highway.
It's a diagnostic landscape that is entirely contradictory. I mean, the overarching theme here is really just, it's paradox. We're looking at this booming, multi-trillion-dollar tech market trading record volume.
Insane volumes, yeah.
And sitting directly adjacent to that, I mean, literally right next door in the data, we have factory job cuts nearing outright crisis levels. S&P is reporting job losses in manufacturing that rival the early days of COVID, or, even the 2008 financial crisis.
Okay, let's unpack this, because that is the paradox we're mapping out for you on today's deep dive. We have this comprehensive daily market briefing, and it is sending incredibly mixed signals.
Very mixed.
You have bizarre job data, massive geopolitical shockwaves, and inflation numbers that just refuse to cool down. Our goal today is to cut through all that financial noise.
Because we really need to figure out how a struggling factory worker, a surging tech stock, and an oil tanker in the Middle East are all reacting to the exact same global pressures.
Yeah, exactly.
To understand what is happening in your own portfolio, or even just why the price of goods at your local grocery store is fluctuating, you have to look at the hidden architecture connecting these seemingly isolated events. The data is noisy, but the underlying mechanisms actually tell a very coherent story.
Well, let's start with the foundational macro numbers from the briefing because, frankly, they are running incredibly hot. The core inflation rate hit 3.4% in May.
Which is high.
Yeah, it's the highest we've seen since October of 2023. And overall, consumer prices are up 4.2% annually, which is a 3-year high. Wow.
And then wholesale prices just jumped 1.1% in May alone. That's driven largely by this massive energy surge. Plus, the Personal Consumption Expenditures Price Index, the PCE, that's expected to show a 4.1% annual increase.
That's a lot of data hitting all at once.
It is, yeah. So before we even analyze the fallout, I want to clarify something foundational for you. We hear core inflation thrown around constantly.
Oh.
What is the actual mechanism separating core inflation from just general consumer prices?
So core inflation is a specific metric the Federal Reserve relies on because it intentionally strips out the most volatile categories.
Leading food and energy.
Exactly, food and energy. Those prices swing wildly based on, say, a sudden drought or an overseas conflict. By removing those, central banks can see the underlying trend of the economy.
Raise a baseline.
Yeah. If prices for durable goods, haircuts, rents, services, if all of those are consistently rising, that indicates inflation is deeply embedded in the system. So a 3.4% core inflation rate means that even if you ignore the sudden spike in gas prices or your grocery bills, the basic cost of just existing in the economy is still climbing at an uncomfortable rate.
That is the real concern, yeah. The cost of goods leaving the factory floor is up, the cost of goods on the retail shelf is up, and that underlying core measure is pointing steadily upward. Inflation is proving to be structural, not just some temporary blip.
And the global reaction to this structural inflation is where the briefing gets truly complicated.
It really does.
Like over in the UK, the inflation rate is somehow holding steady at 2.8%. They seem to be managing it. But the European Central Bank, the ECB, they just hiked interest rates for the first time since 2023.
Right.
They are actively slamming on the brakes. It feels like this frustrating game of whack-a-mole. Just when central banks think they've hammered inflation down, wholesale energy pops back up. Why is the ECB panicking and acting so aggressively right now, while the UK manages to hold its ground?
Well, it comes down to geography and energy dependency. The ECB's rate hike isn't a reaction to European consumers suddenly buying too many luxury goods. It's a direct response to energy costs ramping up as a consequence of the ongoing Iran war.
Oh, interesting.
Yeah. Continental Europe is highly sensitive to fluctuations in global energy markets, much more so than the UK, which has, different energy infrastructures and domestic policies in place.
Okay, that makes sense.
So when the cost to simply power a German factory or heat a French home surges because of a conflict thousands of miles away, the ECB is forced to act to cool down their domestic economy. They're utilizing a domestic financial tool, interest rates, to combat an international geopolitical crisis.
Wow. So if the ECB is hiking rates specifically because energy prices are spiking, who is actually controlling that energy lever right now?
That is the million-dollar question.
Right. And that brings us straight into the geopolitical developments from today's briefing, because this domino effect is happening in real time. I want to list out the major moves impartially because they are sweeping. First, Iran is warning ships that transiting the Strait of Hormuz without their explicit approval is unacceptable and dangerous.
A huge escalation.
Yeah. And at the exact same time, the U.S. just issued sweeping Iran oil sanctions waivers, which effectively unlocks billions in revenue for Tehran.
Right.
Meanwhile, former President Trump is pledging a rapid U.S. response for Venezuela following those historic, deadly earthquakes in that region. And over in Asia, China has widened its export curbs on Japan, specifically targeting drone makers, nuclear firms, and defense institutes.
What's fascinating here is that combination of U.S. and Iranian actions regarding oil. It's probably the most delicate balancing act in the global market right now.
Honestly, I am genuinely confused by that dynamic. If the U.S. is trying to exert geopolitical pressure on Iran through sanctions, why issue sweeping waivers that hand them billions of dollars in oil revenue? That seems entirely counterproductive.
Well, it looks counterproductive politically, sure. But economically, it's a strategic tightrope. The U.S. is issuing those waivers to keep global oil flowing into the market.
Ah, I see.
Yeah, if they enforce the sanctions strictly and pull Iranian oil off the global market entirely, global supply plummets. When supply plummets, energy prices skyrocket worldwide. And as we just discussed with the ECB, skyrocketing energy prices immediately drive up structural inflation.
So the U.S. is essentially tolerating the political cost of funding Tehran to avoid the domestic economic cost of hyperinflation at the gas pump.
Precisely.
Yeah.
They need that supply in the market. But the secondary problem is the Strait of Hormuz.
Right, the shipping lane.
Exactly. Iran is threatening a massive choke point where a significant percentage of the world's oil transits. Even if the oil is flowing today, the market knows that at any moment, a military escalation could close that strait. So the global price of energy constantly bakes in that fear.
Meaning prices stay high just based on the threat alone?
Yes. The market charges a risk premium, basically an invisible tax on every barrel of oil, just in case things go wrong tomorrow.
And that invisible tax ripples through to the wholesale prices we saw earlier. But let's look at the Asian theater for a second, because that China-Japan dynamic feels equally disruptive. China is aggressively curbing its exports of drone technology, nuclear components, and defense materials to Japan.
Yeah, that's a massive shift.
What is the immediate consequence of that? I mean, if China is aggressively curbing drone and defense exports to Japan, doesn't that immediately force Japan to pivot and rely heavily on the U.S. tech and defense sectors to fill that massive gap?
Yes, absolutely. They have to fundamentally rewire their supply chains.
Yeah.
And quickly. Japan relies heavily on those advanced components. If China turns off the tap as a form of geopolitical friction, Japan has to secure those supply lines elsewhere.
And the U.S. is the obvious choice.
Exactly. The U.S. tech and defense sectors are the natural strategic alternatives. This isn't just a localized political dispute. This is the real-time redrawing of the global tech supply chain.
And because that global supply chain is being fundamentally rewired, the effects are showing up instantly on Wall Street.
Oh, immediately.
The trading volume and the divergence in tech stocks today is just staggering. We are looking at massive numbers. Microsoft is up 5.71%, trading over 186 million shares in a single session.
Huge volume.
Apple is up 3.14% on an incredible 261 million shares. Amazon is up 2.50%. But the recent AI darlings, the companies that have driven the market for months, they're taking a hit. NVIDIA is down 1.64% and Google is down 1.84%.
If we connect this to the bigger picture, we are likely witnessing the mechanics of a significant market rotation.
What does a market rotation actually look like in practice? Is money just leaving the tech sector entirely?
No. The capital isn't leaving tech, it's simply moving to a different neighborhood within the sector. Investors are cashing out some of their massive profits from the AI boom and reallocating that money into established mega-cap companies like Apple and Microsoft.
Because they're safer.
Yeah, they're perceived as having more diverse, stable revenue streams. The briefing points out that despite NVIDIA's daily drop, chip stocks broadly are actually rebounding. NVIDIA and Micron are still making significant moves over a longer timeline. Furthermore, Goldman Sachs has racked up a series of tech M&A wins recently.
So the underlying architecture of the tech world is still highly active. Companies are still buying each other, but the everyday investor is just shifting their chips around the table.
Yes. They're looking for stability after a period of intense hyper-focused AI speculation.
And that reallocation of capital is creating some serious drama for legacy tech companies. The briefing highlights two older names moving in entirely opposite
Right,
directions.
Intel and SanDisk.
Exactly. Wall Street has dramatically increased its price target on Intel, suggesting the stock might actually be too cheap. But then SanDisk is dropping heavily due to fears of direct Chinese competition from a company called CXMT. Are we seeing a changing of the guard in tech? Intel suddenly getting massive love while Nvidia drops feels like we stepped into a time machine back to the 2010s.
It really does. But it highlights how markets eventually reconcile hype with fundamentals. We've been in a cycle where any company attaching AI to its press releases commanded a massive valuation
Oh,
premium.
for sure. Just say AI and your stock goes up 20%.
Right. But eventually, the market starts hunting for intrinsic value. Investors look at an older, established company like Intel, a company that actually owns physical foundries, manufactures physical chips, and possesses massive tangible infrastructure, and they realize the stock is undervalued compared to software names trading at 50 times their revenue.
So investors are hunting for value in legacy infrastructure rather than paying a premium for current hype.
Exactly.
Well, while these tech giants are trading hundreds of millions of shares and dominating the financial headlines, we need to shift our focus to the actual ground-level economy, because the data we're getting here is the core paradox of today's briefing.
It's a stark contrast.
Here's where it gets really interesting. The reports show clear signs of economic recovery, right? We have a robust labor market, and consumer spending is increasing at that 4.2% annual clip.
Right.
Yet, at the exact same time, S&P reports that factory job cuts in June just neared financial crisis and COVID levels.
This raises an important question. How can consumers keep spending at a 4.2% higher rate if the factories producing the goods are shedding jobs at literal crisis levels? It points to a deeply fractured economy.
It seems mathematically impossible. You can't have a booming consumer base if the people making the things those consumers buy are losing their incomes.
You can, but only if you have two entirely separate economies living under the same macroeconomic roof. We are looking at a sharp divergence between a thriving, white-collar, service and tech-driven economy and a traditional manufacturing sector that is just buckling.
So we're talking about two very different lived realities. On one side, you have the software engineer or the financial analyst. Their stock portfolio is up, their wages are strong, and they are the ones driving that 4.2% increase in consumer spending. They're buying the expensive coffee and booking the flights. But on the other side, you have the manufacturing plant in Ohio or Germany. They are getting crushed by those 1.1% higher wholesale energy costs we discussed, and their supply chains are being rewired by international disputes. They're bleeding cash, so they cut shifts, and eventually they cut jobs.
And the aggregate data mashes those two realities together and spits out an average. But nobody actually lives in the average economy. You're either experiencing the boom or you're experiencing the recession.
I want you, the listener, to think about this as you look around your own community this week. Are you seeing the tech boom? Are you seeing the new restaurants packed on a Tuesday night? Or are you seeing a hidden blue-collar recession in your local industrial parks that's being masked by the high consumer spending of a different demographic?
Because the math in today's briefing proves that both are happening simultaneously.
Which is wild.
It is. Navigating a polarized environment like that as an individual investor requires abandoning the idea that you can outsmart the chaos by picking one or two winning stocks.
Which brings us to the defensive strategies outlined in our sources. With inflation stuck at 3.4%, tech stocks rotating violently, and manufacturing struggling, how does a retail investor protect their savings?
You have to think structurally.
Right. The briefing strongly pivots away from individual stock picking and introduces very specific ETF exchange-traded fund strategies.
When the dashboard is flashing contradictory signals, placing all your capital into a single company is incredibly risky. You rely on the structural advantages of broad market ETFs. For example, the briefing explicitly recommends the Vanguard S&P 500 ETF, ticker symbol VOO, over the State Street SPDR S&P 500 ETF, which is known as SPY.
Let me stop you there, because that feels like splitting hairs to me. Both VOO and SPY track the exact same 500 largest U.S. companies, right?
Yes, they hold the same assets.
So if I buy either one, I own a tiny piece of Apple, Microsoft, and Amazon. Why strongly recommend one over the other?
The difference lies entirely in the expense ratio, the annual fee the fund charges you to manage the money. VOO charges an expense ratio of 0.03%, while SPY charges 0.09%.
Okay, but that sounds like fractions of a penny. Why does that matter?
because of the mechanics of compound interest over a 20 or 30-year timeline. When you pay a higher fee, that money isn't just gone for that year. It's removed from your principal.
Oh, so it can't grow.
Exactly.
Yeah.
It cannot compound and grow the following year or the year after that.
Hmm.
Over 3 decades, a difference of just a few basis points in fees can literally eat tens of thousands of dollars out of your final retirement balance. By prioritizing the structural advantage of a lower expense ratio with VOO, you are keeping your own capital inside the compounding machine.
Okay, that makes perfect sense. The brief also contrasts two global funds. The Vanguard Total World Stock ETF, ticker VT, which gives you blanket exposure to the entire planet, against the FTSE Emerging Markets ETF, VWO, which is a targeted play specifically on developing nations.
Right. You choose how wide you want to cast your net.
But the real meat of the strategy is the recommendation of a 4 ETF core portfolio for long-term holding. Let me list these out. The sources list Vanguard Growth, ticker VUG, Schwab U.S. Dividend Equity, ticker SCHD, Vanguard Total International VXUS, and Vanguard Energy VDE.
That combination is designed to handle multiple distinct macroeconomic scenarios simultaneously.
It feels like building a financial machine with different gears for different terrain. Like if you think about packing for unpredictable extreme weather VUG, the growth fund, that's your sunglasses for the sunny tech days when capital is flowing freely.
I like that analogy.
Thanks. And VDE, the energy fund, acts as your windbreaker. When geopolitical tensions flare up in the Strait of Hormuz and energy prices spike, driving up inflation, your energy holdings spike with it, offsetting your other losses.
Right.
But SCHD, the dividend equity fund, that's your sturdy umbrella. That mechanism is particularly interesting to me in a volatile market. It functions essentially like owning a rental property, right?
Elaborate on the rental property comparison. I think that's helpful.
Well, if I own a rental house and the real estate market crashes, the paper value of the house goes down, I might be losing money on paper. But as long as the tenant keeps paying rent every month, I have actual cash flow.
Yeah.
I can use that cash to buy groceries, or I can use it to buy more property while prices are cheap. A dividend ETF like SCHD operates the same way. Even if the overall stock market is dropping due to inflation or rate hikes, these companies are still legally paying out a portion of their profits as cash dividends directly into my account. That cash flow is my umbrella in a down market.
That is an incredibly accurate way to understand the mechanism. You are securing yield regardless of price action. And when you add VXUS for international diversification, you're ensuring that if the U.S. economy falters, you have exposure to regions that might be recovering.
Right.
The overarching lesson from the briefing strategy is that predicting the geopolitical weather is impossible. The only mathematically sound approach is prioritizing low fees and building a structurally diverse portfolio that can generate returns or at least mitigate losses in any climate.
So, what does this all mean when we pull the entire stack of sources together? We're looking at a deeply polarized world. We are living in an economy where the macro numbers, like that stubborn 3.4% core inflation, simply do not align with the micro realities.
No, they really don't.
You have crisis-level factory cuts happening at the exact same moment. Big tech is creating hundreds of millions of shares a day.
It requires looking past the surface-level contradictions and understanding the distinct engines driving different parts of the global machine.
And now you have the vital context behind today's financial headlines. When you read about threats in the Strait of Hormuz, you know the mechanical link between that conflict and the price of wholesale goods in your own community.
Exactly.
When you see Intel getting surprising new price targets, you understand the rotation of capital from AI hype back to physical legacy value. You aren't just seeing the isolated data points anymore. You understand how the gears are turning.
And as we look at those turning gears, I want to leave you with a final thought to mull over. We saw in the data today that the U.S. issued sweeping oil sanctions waivers to Iran, unlocking billions in revenue to keep global oil flowing.
Right.
At the exact same time, the European Central Bank was forced to hike interest rates to cool their economy, specifically because of energy costs directly tied to the Iran war. In a completely globalized economy, where one nation's political waivers dictate another continent's interest rates, is it even possible for a single central bank to control its own economic destiny anymore? Or are we all just at the mercy of geopolitical test moves?
Man, that is a heavy question and a perfect place to leave it. The diagnostic dashboard might be flashing mixed signals, but hopefully we've helped you read the gauges a little more clearly today. Thank you for joining us on this deep dive, and as always, keep questioning the headlines.